right, good morning, everyone. It is 9:44 in the morning of August 30th, 2022, and this is my it's supposed to be pre-market strategy session, but this one is what's the word for not pre-market, not post-market, but anno domini in the life of the market. So, all right. In the years of the market, actually, technically speaking. So anyway, here we have the cues, and we have a support and resistance zone, sort of right in this area where price is right now. Right in here is support and resistance. You can kind of see it here in late April into early May. Price, kind of broke down below this level, popped back up above, stayed there for a little bit, and then fell out, and then did manage to put a bottom in right here, and that is very bottom-y looking. But in a bear market where we have sequential economic quarters that are looking rather weak, as far as GDP growth goes, and the change in the rate of acceleration in inflation, then both of those are slowing, and this ought to be only a temporary bottom. The next leg down ought to take us somewhere in the neighborhood of about 240, roughly. So right now, what it looks like to me is happening is buyers and sellers are attempting to discover price in this support zone again. And this is only my guess. My guess is that this price zone right here will break down, and we'll get something similar looking to this move up here. And we'll get something similar like this for a move down, like that. So actually, you know what? I put scribblings on my SPY yesterday. Let's see if they're still. 2 days ago maybe I put them there. Let's see. Let's see how accurate. Yeah, the day before yesterday. No, okay. So yeah, my scribbling wasn't accurate at all. Yeah, oh, wow, look at that. The SPY's really taking a hit today. The Qs aren't. The Qs don't seem to be. Oh, nope, it's fallen out. Yeah, okay. Yeah, that's to be expected. Yeah, so price zone is right. It's right at a price zone right now of support and resistance. I think a breakdown kind of below this 303 area roughly will bring lower prices for the day. Looking at the daily, this is looking like on the daily chart that price is going to bounce around here in this zone for a few days, and you can see over here that it was for 8 days where it bounced around in the zone, actually 7 days where it bounced around in the zone. On the 8th day it went down, and then here it's been a few days trying to hammer out this zone 2. So my guess is that it'll probably spend somewhere around 5 days in this price zone, in this price area, and then it'll be on its way back down again. And so to put a Fibonacci on it, it wouldn't surprise me to see the price go as high as, let's look here, back to the 313 area for a little relief rally before it starts to roll over again. And let's see what the previous bounce rose to. It looks like it didn't even make it to the 50. Oh, made it to the 38.2. Yeah, which is the opposite of the 61.8. So if I go the other way with it, let's see, from there to there. Oops. From there to there. Yeah, it went almost right back to the 61.8 and failed. We'll see on a closing basis. Let's see what it did on a closing basis. Yeah, close to the 61.8, and then went down again. So on this leg right here, I will be a strong seller. Let's go closing basis. I will be a strong seller if the market can make it back up to, what price is that? It's hard to see. 314.40. If the Qs can manage to rally up to 314, and actually in between the 312.50 and the 314.40, there's like a $2 range there. I'll start pressing my shorts again. And that's kind of all I've got for today, really. Everything else. Actually, let me. I haven't looked at gold. Let's check out what gold is doing. See if it's on the move. Yeah, not really. Yeah. So I think things are going to start crashing again, and in a crash, all correlations go to one, or -1, I should say. So some equities do better given certain economic conditions, like the utilities and energy and staples versus what would be other risk assets versus gold or metals or commodities and so on and so on. But in a crash, all correlations go to -1, and so just everything sucks, generally speaking. Let's take a look at the 10-year. Here's the 10-year. Okay, yeah. So rates are rising on the 10-year. The bond market always gets it right. This is interesting though. So Head and Shoulders is my favorite reversal pattern. And what could be shaping up here is a reversal pattern in rates. Here's the left shoulder. Here's the left shoulder. Here's the right shoulder. Here's the head. And we have a neckline that's pointing in the opposite direction of the previous trend. Yeah. Looking really toppy. Rates are looking really toppy right here. So a breakdown below this neckline means people are going to be piling into the 10-year as a safety trade. Let's take a look at the 10-year, 2-year split or spread here. It's heading back down again, back into the negative. Okay, well, so let's see. Let's look at the 2-year. What's the 2-year doing? 2-year. Yeah, 2 years. 2 years on its way up. This is yeesh. So yeah, people are selling 2-year, going to 10-year, looking for safety, and the yield curve ought to continue to invert. Yeesh. Oh boy, if this is the next leg down, if this starts the next leg down on the 10-year, 2-year inversion, it'll come to what will be a low in my experience. I've never seen it go this low before. Here, let's go to a monthly chart. Let's see, the lowest low is back here in 90. I wasn't paying too much attention to the stock market back here in what year is this? The low down here in 89. So that's on the charts. This is the lowest low. It's back here in 89, and I don't remember the 90s, the beginning or late 80s to early 90s being all that recessionary, economically speaking. So you see here in the 2000s, it came and touched that area, touched those lows. Actually broke down below, actually. So that's the lowest low. It's hard to see with the scribbling here. Let me get rid of these marks that I put on the chart. Kind of indicate, they don't actually just kind of indicate, they do indicate. This is where the yield curve inverted. And this is where the yield curve started to normalize again, and this is where the crash started to happen, actually. And the blue lines indicate the start of a market crash. The 90 market crash, the 2001 market crash, and the 2007 market crash all started in these months, in these time frames, and that's when the yield curve started to normalize again. So let me get rid of the scribblings though, because it's making what I want to look at kind of difficult to see. So record inversion is at 699 points in the negative, and it looks like we could be heading on back down to those as far back as this chart goes, and it goes back as far as February of '88. So we could be going right back into those into that zone again, into this negative zone again. The economy is forecast to the second quarter of 2023 right now, Q2 of 2023 is expected to be negative. Tough economic conditions, slowing growth, and a slowing rate of inflation. All right, everybody. Good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell. And I will see you at tomorrow morning's pre-market strategy session. I am out.